Next, for more on housing, let's bring in Ethan Harris, co-head of global economics research at Bank of America Merrill Lynch. He's one of the most accurate forecasters on the economy, making him a Bloomberg best. And Ethan joins us now from his office here in New York. Ethan, welcome back to Bottom Line. Always a pleasure.
Thank you.
Ethan, new home sales seem to be on pace for the worst year since the government began keeping those records a half-century ago. There was a time when new home sales were an indicator of how the broader market was doing, but that's not the case now. How slow a return to normal are we witnessing?
Well, I think we've got another 2 years before we get any sign of real growth in the housing market. And even that forecast is predicated on the idea that the economy keeps growing in the next 2 years. We need growth to clear out all those foreclosed homes. Then we can start thinking about a normalizing housing market. Right now, though, we're right in the middle of that clearing out process.
Ethan, you just spoke about those foreclosed homes. Talk to me about the competition between home builders and the sales of existing homes and foreclosed properties. How's that dynamic playing out?
Well, these days, both home construction and new home sales are basically a specialized market. In areas where there aren't foreclosed properties available, people are building. There's homes that people want specific aspects in the house that are being built. There's renovations and so on. But in markets where there are high foreclosure rates, the competition's very fierce, very low pricing, very weak new home sales.
Ethan, high unemployment, bigger down payment, tougher lending standards, they're all factors keeping people from buying homes. And now, with the global economy on this bumpy ride, do you see any macro indicators that this sustained pressure on housing is going to break anytime soon?
No, I think the best we can hope for is kind of a nursing back to health in the housing market. The various proposals you talked about in your earlier segment would, on the margin, help things, but fundamentally, it's going to take time to heal the wounds. Certainly we'd be in better shape if we had a steady drop in the unemployment rate going on. If we could get this economy growing at a decent pace, that would speed up the process. But I think we're kind of stuck in the mud here for quite a while.
Ethan, last week, as you know, the Federal Reserve said that it was going to buy back over $400 billion of bonds in that move called Operation Twist, an attempt to drive down long-term interest rates. Will borrowers benefit from lower rates on mortgages?
A little bit. I think you've heard a lot of guests say that, this is not the fundamental problem right now, and I think that's right. On the margin, is it better for the Fed to do something and at least present themselves as trying to help work through this crisis? I think it is. Is it really going to make a big difference? I don't think so.
Well, even with mortgage rates at historic lows, consumers aren't biting. How much lower would they have to go before renters decide to become owners? Or is, as you just mentioned, this just still tied to that jobs market, that stubborn unemployment rate over 9%?
Yeah, there are two things that'll get the housing market going. One would be a real jobs recovery, and the other would be to stop the downward pressure in home prices, because even if you take out a 4% mortgage now, if you think the price of your home is going to fall 5 or 6% a year, then your real cost of funding is more like 10% if you look at your overall investment. So getting mortgage rates lower helps in the margin, but a much more important thing is to create demand through higher job growth, and to get through this foreclosure process, stop the downward pressure on home prices.
Ethan, if I might ask you before we leave, give us a sense on how these declining home prices are destroying household wealth in this country and the effect that's having, therefore, tangentially on consumer spending?
I think that this is a very important story. It's not just that there's this gradual loss of wealth, it's that it's happening to so many people. The home is the most broadly held asset in the U.S. economy. And it's also that this asset is losing value and it's illiquid. It's very hard to sell your house these days. So this is a major weight around the economy. I don't think we can really declare victory over this crisis until we see a real housing market recovery.
Well, how does this also then reduce access to credit?
There's a vicious feedback loop, right? So the housing market's distressed, makes it hard for people to borrow and invest in their home. That contributes to a weaker economy. That makes it even harder for the housing market to recover. Again, we need time, and we also need effective policy that supports growth. Your earlier segment talked about the impasses in Washington. the best thing those guys could do would be to start talking to each other like adults and stop the negative uncertainty shocks they're putting into the economy every time they threaten to shut down or default on the debt. That would help growth. That would indirectly, over time, benefit the housing market and the overall economy.
Yeah, that's interesting. Thomas Friedman, again, I go back to him. He wrote in his column in the New York Times today, the leaders, President Obama, the Republican and Democratic leaders, don't want to be the ones at the helm if history regards something that's going to be more awful going on in this economy. Ethan Harris, head of global economics research at Bank of America Merrill Lynch, joining us from here in New York. Ethan, it's always a pleasure. Thanks so much.
Thank you.